thousands of ETFs to choose from in Europe. How does the Belgian investor pick the best ones? That's the question that we're answering here today through this video. Before let's get into it, let's actually explain what an ETF is. So an ETF, also known as an exchange traded fund, it's a collection of tens, hundreds, or sometimes thousands of stocks or bonds. This spreading is one of the most attractive aspects of owning an ETF compared to individual stocks and bonds. By investing in a single ETF, you actually become invested in thousands of companies in one go. A popular ETF for Belgian investors is the VWCE. This fund tracks the FTSE All World Index. As its name implies, the index is global. It consists of over 4,000 companies from more than 40 different countries. So let's get into the actual criteria that we should be looking out for as Belgian investors. So the first one that we're going to look at is accumulating versus distributing. Any Belgian that perceives a dividend has to pay a 30% tax on it. As the name suggests, distributing funds distribute their dividends, which means that they're taxable. So no matter if you have a stock or a bond ETF, you'll have to declare and pay that tax. On the other hand, accumulating funds directly reinvest the dividends into the fund before you ever receive it. The dividend translates into a greater increase in the value of the fund. Unless you have a really good reason not to, highly suggest buying only accumulating funds because you won't be taxed on the dividend. As capital gains are not taxed in Belgium, this means that your cumulative ETF will not be taxed when sold. The second criteria we're going to look at is domicile. So Luxembourg and Ireland have special tax treaties with the US that make it attractive to set up funds there. As a Belgian investor, you actually benefit from this by investing in funds that are domiciled in one of those two countries. For example, the popular FTSE All World VWC that we mentioned earlier is domiciled in Ireland. You can actually tell it from its ISIN code. It begins with the letters I and E. That stands for Ireland. The ISINs of funds domiciled in Luxembourg start with LU. So the next criteria is currency. So if you buy a fund that's not actually traded in euro, the broker is actually going to convert it for you. However, the broker sees this as another source of revenue, so it often comes actually at an additional cost. For this reason, it's best to invest in funds that are trading in euro only. So the size. The fund size is actually a good indicator of a product's popularity. As an investor, you're looking for an investment that is viable in the long run, so you'd want to avoid a fund shutting down after a couple of months. As ETFs must actually reach a certain size to become viable, a larger fund is less likely to shut down. Also, larger funds are easier to buy and sell because there are more players in the market. The type of asset. This is another criteria. When you're choosing your ETF, you need to select the right asset class. So there's equities, bonds, commodities. Each has its role in an investment portfolio. For instance, it's often recommended to invest more in bonds as you get older because lower volatility becomes important as you approach retirement. In Belgium, profits on stock funds are not taxed, but the gains on your bond funds will be taxed due to something called the Reinders tax. As soon as a fund consists of at least 10% bonds, there's a 30% tax on the profits made when selling. So this is a difficult one as your instinct would be to go 100% all in on stocks to avoid paying the Reinders tax. But stocks can go up and down drastically, and you may actually need an allocation to bonds in order to be able to go through the downturns without panicking and making irrational decisions such as selling all your investments. Such a mistake is actually more costly than paying some Reinders tax on your bonds. The next criteria is replication. This you should avoid at all costs. Some index funds are actually cheaper through a technique they call synthetic replication. Basically, instead of actually buying the shares of the companies in the index, they use financial engineering to replicate the returns of the index by making a deal with a third party. It's usually a large bank. It sounds a bit dodgy. We think so too. The main issue with synthetic replication is that it introduces an additional risk coming from the counterparty. And when you're investing your life savings towards your pension, we want to limit the risks that are really avoidable. So what are the costs of an ETF? So fund managers, they actually charge a fee for managing their funds. the total cost of a fund is indicated by the total expense ratio, that's the TER. They automatically deduct it from the performance of the fund, so when you actually look at a fund's performance, it is usually presented net of fees. As a Belgian resident, there's actually a tax on the transaction that's called the Bourse tax or the taxe sur les opérations boursières or TOB. And that's every time you buy or sell a security. If the ETF you're purchasing or selling is actually registered on a particular list maintained by the European Economic Area, then the tax actually equals to 0.12% of the transaction amount. justETF is honestly the best resource that we've come across to compare ETFs. It shows most of the information that we mentioned in this video for thousands of ETFs available to us as Europeans. So let's actually look at the VWCE one. As you can tell from my screenshot, there is a lot. But choosing an ETF is actually not the end of the story. It's actually a small part of you building a portfolio that's going to give you success over the long term. And defining the right portfolio is probably the most important and most difficult task for every single investor. The composition of your portfolio is actually dependent on your goals, your appetite for risk, your age, and also your income. And so we understand this difficulty along with the many other subtleties investors have to deal with in order to be successful over the longer term. So if you're looking to actually take all of these complexities away, we encourage you to take a look at Curvo, the product that we've been building. But all right, to conclude, if there are any that you should remember from the criteria that I listed, there are two. Always select an accumulating ETF to avoid paying dividend taxes. And secondly, invest in funds domiciled in Ireland or Luxembourg. All right, thanks for watching. Leave us your comments and we'll get back to them as soon as possible.